We all know about budgeting and debt and the words that are related to that, how to talk about it. But you also want to know how to talk about wealth, right? As much as I hate financial lingo, sometimes we need to speak it to be able to build wealth and manage wealth. One of my financial coaching clients said to me not long ago, I just want to go in and understand what my financial advisor is talking about so I can stop pretending that I know what he's talking about. That comment inspired me to make this video. I'm going to run through 21 terms I learned over the past 40-ish years of investing so that when you hear these, you'll understand them as you analyze your investments or work with a financial advisor if you choose to do that. If you work with a CPA and you need to talk about your investments and what's happened, or other financial specialists, it's just something that you'll want to know. Now, these terms sound complicated, but they're really fairly simple, as you're about to see. Since I'm just a long-term investor myself, I use everyday language and I like to keep it really, really simple. So I'll run through these as quickly as I can, and I'm saving my favorites for last because I want you to remember them. I think they're super important. Hi, my name is Camille Gaines. Welcome to Retire Certain. This channel is all about helping people build wealth with slightly alternative methods that don't take decades to actually pay off, and also about creating slightly alternative and diversified income streams so you can live well and enjoy life both now and later on. The very first term is capital, and capital is just savings. It's the amount of money that you put aside that you're going to invest. But when it comes to investing, instead of saying savings, it tends to be called capital, which really kind of makes sense. The next term is realized capital gain, and that just means that you sell an asset for more money than you paid for it. An unrealized capital gain is when you bought an asset and it increased in value, but you haven't sold it yet. You just saw the value of it go up on your brokerage platform or on your brokerage statement if you still happen to get one of those. The next term is investment objective. That simply means why you're buying an investment. It's the reason you're investing in something. It might be for preservation of capital, or it might be for income, which leads me to the next word is preservation of capital. And that just means not losing your money. Often, this is seen as a goal or an objective with investing. The next term is capital appreciation, and that just means when an investment increases in value. It's related to having a capital gain, but capital appreciation is often what the word or the term that's used when talking about investment objectives, which is like a goal. Income is the next term, and as simple as it is, it's often used in investing, but it's also a common investment objective. And of course, income just occurs when you own any investment and it pays you for owning that investment. A good example of this is stock dividends that you receive while you own the stock. Yield is simply the measure by which an investment pays you that income while you own it. Asset allocation is putting a certain percentage of your money into different types of investments with the intention of lowering your risk by having those different investments and also increasing your investment returns. The next one is super important and nobody really talks about it. It's called beta, and it's a measurement that shows you how volatile an investment is relative to the overall market that is close to it. For example, if the beta of a stock or a stock fund that you're analyzing is 1.5%, then that stock or fund is about 50% more volatile than the overall stock market that we see in the S&P 500 index. Broad market is the next term. It represents a large group of assets or securities with a commonality. The broad market is often thought of as an index. For example, the S&P 500 is used to represent the broad U.S. stock market, as you probably heard here on my channel if you don't know that already. Correlation is the next term, and correlation explains how closely two assets move in value. In other words, it will show you if two different investments move in the same direction. That's really important. Knowing this helps you reduce your risk by diversifying or buying into assets that move opposite each other. All your investments, when something happens, all of them don't go up or down. Up would be nice, but they don't all go down at once. And that's sort of the payoff, is that some are going to go down when others are going up most of the time. But diversification is important because it helps you keep your money safer. For example, U.S. Treasury bonds usually increase in value when the U.S. stock market decreases in value or when the stock market enters a bear market. Bear market's the next term. A bear market is when the stock market decreases 20% or more. Alternative investments. Alternative investments are generally investments other than the most commonly owned stocks and bonds. Alternative investments is kind of a broad term that can mean different things, but that's how I define alternative investments. I think everybody invests in stock funds and stock index funds and bond index funds, the most common and popular investments. So to me, something that is a little different and outside the box is an alternative wealth strategy. It's an alternative investment. Slightly alternative investments, I know, I invented this term myself out of necessity, but what it is slightly alternative investments are those that are only a little bit different from the most common investments. Examples of slightly alternative investments are REITs and their MLPs. And the reason I think this is important is because a lot of times people hear alternative investments and they think it's something really exotic like tulips or or Bitcoin or something that's new and perhaps riskier. But alternative investments or slightly alternative investments are just a little bit different. You can still buy and sell them on the stock market, but they're not the typical investments of stocks and bonds that almost everybody owns. And then the next term is REITs, and that stands for Real Estate Investment Trusts. And those are publicly traded trusts that allow individuals to buy into huge real estate projects and properties like shopping centers and office buildings. And then the next term is MLPs, and that stands for Master Limited Partnerships. And these are huge partnerships that you can buy on the stock market, just like you can buy stocks, which are in the energy, usually service industry. The next term is financial independence. And I define financial independence as when your investments generate enough income to cover all of your living expenses. This income may come from investments in stocks and bonds, real estate, or more alternative investments. The next term is correction. A correction is when the stock market decreases less than 20%. We said just a second ago that a bear market was a correction of 20%, or a decline, I should say, of 20% or more. Well, the correction, which happens more often, almost every year, is less than 20% decline in the price. Then the next term is real return. Real return is so important. Nobody talks about it. The return that you get from an investment after you factored in inflation is the real return that you're getting. For example, a money market fund that's yielding 1.7% when inflation is 2% means that you're really getting a slightly negative return. And just think, if you have to pay taxes on that money, you're really getting a negative return. So factor in inflation whenever you think about, or when you're comparing yields, or when you're thinking about how much income you'll get from an investment. Now, note that a 1.7% money market yield and inflation of about 2%, a little bit under 2% as I record this, but these are very realistic numbers nowadays. So negative income or negative return from a money market is very much a reality these days for investors as of this recording. And it has been for quite a while. Now, alpha is the next term that I want to mention, and this is super important and nobody really talks about it, but it's the performance of an investment when compared to the closest index, which is also called a benchmark, which I mentioned earlier. Ideally, investors, funds, and financial advisors, anything that you're putting your money with and into will beat the alpha of an index after fees are considered, because, well, everybody can, get alpha even without any effort just by buying an index fund. The next term is benchmark. I thought I'd already said that one, but now here it is, and it's really important. And it's the performance of an index that most closely relates to an investment. For example, the S&P 500 would likely be the index for a portfolio or a fund with many large company growth-oriented stocks in the United States. And benchmarks give us a great way to evaluate investment funds, wealth managers, and also financial advisors. The 4% rule is the next term, and the 4% rule, you may have heard me talk about here, it's a plan to withdraw 4% of your investment from your investment account every year to live in retirement. If you're thinking you don't want to spend or plan on spending your hard-earned savings for 30 years or so in retirement or living on less, me neither. And this is what fueled our income stream adventure over the past 15 years, which you may have heard me talk about here and which I write about on my blog, retirecertain.com. If you want to see what's worked for us on that 15-year income stream adventure, watch this video next.